Thanks for tuning in to this episode of the Resilient Advisor Show. My name is Jay Coulter, and joining me for this episode here at the end of 2020 is accountant Shelly Bykat to talk about year-end strategies for individuals, businesses, and estates. Shelly Bykat is a certified public accountant in Atlanta, Georgia. Full disclosure, Shelly has not only been on the show a couple of times, she's a very good friend of mine and my own personal CPA. She's agreed to come on the live stream, take your questions, but she has also brought some great ideas for financial advisors as we roll in here into the new year. Shelly, how you doing?
I'm doing great. Thanks. How about yourself?
I'm doing fine. You're up in West Virginia. You've taken the kids to go do a little bit of skiing. Tell me, how's business been for you and your accounting practice this year?
Crazy busy, nonstop, which is a great thing. But yeah, it's been really busy.
Awesome. And your typical client, is it a small business owner, an individual, or do you span the gamut?
Yes, small business owners are my bread and butter. I do a lot of work holding their hands and planning and try to make life easier. And I try to make life less stressful as it relates to the IRS.
And yes, I can tell you for a fact that Shelly does that. All right. So for financial advisors listening, we've broken this down. Shelly was so kind. She put a lot of work into this episode. And then, of course, they changed some rules, didn't they, Shelly?
Yes, they're in the process of doing that as we speak.
So before we get started, before we get started, viewers, if you're watching live on LinkedIn, YouTube, Twitter, or Facebook, and you want to ask Shelly a question, simply type a comment and I can pose that to Shelly here during the live broadcast. So Shelly, you put together a list of things that advisors should be thinking of that has changed because of the changes that are happening. Before we get started, let's talk about what are some of those changes that you have seen?
Well, as we all know, or may or may not know, the PPP loans have been a part of our lives this year. And for a while, the IRS has been pounding us saying that if you use that money to pay payroll, you cannot deduct those expenses. And the AICPA, which is the American Institute of Certified Public Accountants, has been fighting them on it. So because they thought that Congress had intended all along that those expenses should be deductible. And the IRS came back out recently and said, nope, can't deduct them. Can't deduct those expenses. So with the law that Congress has agreed to right now, the law is going to allow those expenses to be deductible, which is a big deal because the big thing was going to be if you had payroll expenses and you used money from the PPP loan to pay those, that basically meant your income was going to be up because you couldn't deduct those expenses. But now that Congress has changed it, those expenses will be deductible, which is great for business owners, especially if your income is up this year.
Yeah. So an idea for financial advisors who work with business owners, or just as importantly, if you're prospecting a handful of business owners, pick up the phone and give them a call. You might be giving them some information that their accountant still has not reached out to them with yet. Talk about some value add there. Shelly, you had some other thoughts around PPP as well as it relates to small business owners, correct?
Yes. The other thing to keep in mind is the QBI deduction and the qualified business income deduction, which came into law back when we got the new Trump tax law. The write-off is limited to 50% of the W-2 wages as part of the calculation. It's a very complicated calculation, but originally they were saying those wages, if they were part of the PPP loan, you couldn't use those wages, which meant your deduction would have been limited. But now, because we can deduct those expenses, it's increasing that limit. So it's another great opportunity for taxpayers. So yes, please speak with your clients about this. It's good planning. It's a great planning strategy.
And Shelly, for that, is there time sensitivity to that before the end of the year?
Well, you got to get your payroll in. That's really what people are doing right now. Small businesses right now, this is when we're calling payroll company and running bonuses and running payroll. A lot of companies pay bonuses at year end. And so that's what we're doing with clients right now, getting ready for all that.
Okay. Business owners, you say that there's some good news as it relates to charitable contributions. Walk us through that.
Well, the other thing that we were able to change this year with that, again, QBI calculation, which is great if anybody's taken advantage of it. Last year, they reduced that income by the charitable contributions, which they've reversed that. So if you make charitable contributions to your company, you no longer have to reduce that QBI income by those charitable contributions, which is great. It's a great, gift. It means that 20% could go higher. That 20% write-off could go higher.
All right. And the last thing for business owners that you're recommending to put eyeballs on is the retirement contributions. Walk us through it.
Okay. So investment advisors, this is really important with your clients who are trying to get their 401k, solo 401ks funded by year end. You got to make sure your wages are up there because the profit sharing calculation is based on those wages. So the year for 2020, the gross wages need to be at least $150,000 to fully fund the 25% profit sharing portion of the solo 401k. Also, make sure that the employees have included their employee withholding of $19,500 through their payroll. I find a lot of clients wait till the end of the year and forget to report it, and then they have to increase the payroll to get it through. If your clients are 50 or older, they get to do an additional $6,500. So just encourage them, if they have the cash, to go ahead and get that funded before year end. They don't have to do the profit sharing, but the payroll has to be funded.
Yeah. So advisors, if you're working with an accountant, helping them on some joint clients, great talking points right there for small business owners. Shelly, let's switch gears and move on to the individuals. You have some ideas here for the end of the year.
Yeah. So the big thing this year has been IRA distributions for people. If you have taken out money from your IRA, up to $100,000 this year can be taken out without penalty. You have to meet the COVID rules, and there's a bunch of hoops you have to jump through. It's probably not as difficult as you would think if you got sick, if you were furloughed, if you had to stay home and take care of your kids. But this is an opportunity for you to take money out of your IRA and not pay the penalty. It will be subject to income tax if you do not put the money back. So you can either take the money out and you can pay income tax over a 3-year period, or you can put the money back into the account and you're not subject to the 60-day limit like you typically would be.
Shelly, have you seen a lot of people taking advantage of that, or is that outside your purview since you work with business owners primarily?
Well, I did have a client email me the other day and asked me if they could do that. So some are doing it. I haven't had a lot of clients ask me. Unfortunately, or fortunately, I think for the most part, my clients haven't been hit as bad. I think it's more the retail industry, and I haven't had to deal with that as much.
Okay.
Yeah.
It seems to me, and this is as a novice, if somebody has the ability to pull out $100,000 out of a retirement account, they probably still had their job. And this isn't as beneficial to people who really are struggling the way the economy is struggling. Is that a fair assessment?
Yeah, I would think so. But there are some people who live above their means. We all know them.
Surely there are no advisors watching this that know clients that live above their means.
Yeah, you'd be surprised what I see.
Yeah, that's right.
It's a unique tax planning opportunity. And the beauty of it is it's not all based on 2020. So if you pull the money out and let's say you get a job early 2021 and you have the cash to put back in, and even if you've put it back in before you file your 2020 tax return, you don't have to pay income taxes on that money. So it's not 12/31 is not the cutoff date for this. So just keep that in mind.
Got it. All right. Next, NOLs. Walk us through. You have a couple of items around those.
So the IRS hates net operating losses because basically what it means is you can take losses that you incurred this year and carry them back to a prior year when maybe you had a really good year and you paid a lot more in income taxes. They keep changing these tax laws. Well, because of what's going on right now, they've loosened up the laws again. And for 2018, 2019, and 2020, if you have a net operating loss, which is a business, it comes from businesses. So if you have clients who had losses in their business, you might want to pick up the phone and call them. They can carry those losses back 5 years. And then if they don't absorb all the income, all the loss in the first year they carry it back, it comes forward until it gets fully absorbed.
Interesting.
So it's a good tax planning tool if you have clients who have losses.
Yep. And it really helps you differentiate yourself from the advisor down the street that's only cares about, which mutual fund or annuity they're putting their clients in. So that's an excellent idea, Shelly.
Yes.
Next, I love this. Tell me something that you'll never hear a CPA say, Shelly.
It depends. If you pick up income, so in 2020, you should pick up income if you can. Okay? I know that that's shocking, but because of the potential for the tax laws to change in 2021, depending on what happens in our senatorial race in the state of Georgia, if Republicans lose the Senate, we are going to have sweeping tax law changes next year. The taxes are going to go up. The tax rates are going to go up. So what we want you to consider doing is going ahead and picking up income in 2020 when the tax rates are lower and save deductions for 2021. Now, it could be that they don't win the Senate and the tax law doesn't change, but that's the big planning idea that people are using right now. So if you have clients who haven't paid, you might want to get on the phone and ask them to go ahead and get you paid before year end.
Yeah, Shelly, I couldn't imagine you ever telling me to go ahead and pick up some income for my own personal situation. So I'm looking forward to that.
Yes, it's painful. I know.
Oh, gosh. All right, so sticking with individuals, you have some thoughts around charitable donations and contributions.
Yeah, so if you itemize, it's really important that you go ahead and make the charitable contributions because you get to deduct those. They've released the limits for the charitable contributions. If you make cash contributions this year, typically they're limited to about 60% of your income. And as long as it's cash, you can donate up to 100% of your income and write it off. I mean, I don't know that anybody's going to do that, but if your income's low this year and you have the opportunity to go ahead and do that. So, and also another thing that you should consider doing is if you have appreciated stock. I have some clients that do this where at the end of the year they have appreciated stock. The stock market's up right now. So you could donate stocks to charities and take the fair market value of the stock as a write-off, not your basis, but whatever the gain is. And what happens is that keeps you from having to sell the stock and pick it up in income. The charity will take the stock and they'll immediately sell it. But you don't have to pick up the gain, but you get the write-off for the appreciation.
Yeah, and that's a good process and strategy in any year, right? Or at least the last several years, right, Shelly?
Yeah. Yes, absolutely. Okay.
And lastly, as it relates to individuals, you have some thoughts around, even if you don't itemize, make sure you donate at least $600. Why is that?
Well, okay, so the law that changed earlier this year was $300, but with this new law that they're working on right now, they changed it to $600. So typically, you only get to write off charitable contributions if you itemize. But with the new law, they're going to allow you to donate $600 to charity and write it off. So if you take the standard deduction, please make sure you pay at least $600 to charity this year because you will get to deduct that. Excellent year-end advice. And I guarantee you most advisors are not calling their clients with that right now. Or at least talking to their CPAs about it. I guess they're not going to actually give that advice. Yeah.
Yep. And so lastly, you have a couple of ideas around estate planning at the end of the year. Walk us through what you're thinking.
So this is the one everybody is shouting, the house is on fire. This is what I'm hearing in my world. So if the Senate, again, does not stay in the Republican hands, they are going to probably drop the state tax exemption from almost $6 million, probably down to about $3 million. That's a big difference, especially if you have wealthy clients who've, really built up their estate. So there are estate planning attorneys out there who are very busy right now. I've noticed that. But if you could get with them and start trying to get some things going, I would really recommend it, trying to capture that $11.58 million before the end of the tax year. Because otherwise it goes back to $3 million. There's nothing you can do. But if you go ahead and take advantage of it before year end, you get it. It doesn't matter. It's not going to be, they can't take it away.
Mm-hmm.
At least the way the law's written right now, they could change that.
That's right.
They always think things.
That's right. And then your last thought is around gifting here at the end of the year.
Yeah, another great tax planning tool is to go ahead and give $15,000, get it out of your estate. And you can do, if you're married, you can each do $15,000 to one person. So it's just another way to get wealth out of your estate if you have cash or stocks or, whatever else it is you want to do.
Excellent.
Before year end.
Shelly, as always, you're a wealth of information, and especially since I asked you to keep it in under 20 minutes, you do a great job of getting it boiled down to exactly what financial advisors need to know. If an advisor wanted to reach out to you, how would they get a hold of you, Shelly?
You can email me at Shelly@Bykat, BYKAT, CPA.com, or you can call me at 404-210-0577.
Awesome. Shelly, thank you so much for your time today.
Thank you. Have a great day.